Hey everyone, I'm super excited to talk to you today about what happens when you get a property in escrow and that property does not appraise for the price you're in escrow at. Look, we've all been taught that if that happens, you have to bring in additional amounts of cash in order to close the property. But guess what? I'm here to tell you today that's not the case. You can still proceed with purchasing a property even if it doesn't appraise for minimal amounts of cash down. Let's check it out. So today we have a really fascinating topic. You know, in the market that we're in right now, we have low inventory and we have people competing for properties. So we want to talk about what happens when you get into escrow on a property and it doesn't fully appraise. So I have Tim O'Leary with Guaranteed Rate here, who is an expert in this topic and wants to just teach us all a little bit about some strategies or different ways we can go about when a property doesn't appraise. So Tim, thanks for being here.
Oh, it's a pleasure, Jodi. Thank you for having me.
Yeah, so you have a tool that you can share with us and teach us a little bit about how if a property doesn't appraise for what we're in escrow at. So for example, if we're in escrow at $950 and a property doesn't appraise at $950, maybe it comes in at $925, how a buyer can navigate that with maybe not going into their pocketbook.
Yeah. It's a big topic, and again, as you stated, the current market is such that great demand, very little supply. So that pushes values up, and the struggle is that appraisers can only use recent comparable units, units or houses or condos that are in a similar range, and
Right.
it's all recorded. So is the trend continuing to do this? When the trend is up, it's challenging. So there are times where an appraisal gap is it should be part of a contract, but there is a great strategy, and that's what we wanted to cover today. Okay, so what we have here is I'm going to start off on the fourth column. So let's assume a sales price of $600,000, and this is a situation where the appraisal comes up $25,000 shy. Okay. And in a perfect, typically with 20% down, you would be able to do a loan for $480. But in this case, you're going to have to make up the difference out of pocket. And this is generally how most lenders will do it. But we're going to show you something today that you can use. So what happens is it's more cash out of the buyer's pocket. So what that looks like is if the appraisal comes in at $575, that's the basis where the lender is going to go, okay, we're going to lend 80% from that value. The gap between $600 and $575, that $25,000, will need to come out of pocket from the buyer. Does that make sense?
Meaning they have to put an additional $25,000 cash down.
On top, that's correct, right. And so as you can see right here, I've highlighted it. That figure is $150,473. Okay.
Because you're including their 20% plus $25,000.
That's correct. That's right. Now, let's go to the first column. In the first column, you're going to see what it's like as if the appraisal came in right on spot, and this would be a perfect world. There is your cash to close, $130,568. Okay. Monthly payment, $36.25. As we go to the next column, what we have here is the payments are all the same, but notice what's changing. It's the cash to close. So here is the difference. What you're going to see is this is the second column reflects what's called a one upfront mortgage insurance premium. So it's not included in the monthly payment. It's just an additional cost out of pocket for the buyer. So think of it as a closing cost, and that's really what it is. So that's going to bridge that $25,000 gap with a one-time premium, and the lender will lend you, that's $1,968. That's a lot better than $25,000.
Right.
Right. So now as we go along, if we follow that same path, this is where it comes in at $550,000. So the premium goes up. You see this premium right here. Let me see if I can highlight that. Oh, nope. But it's $4,464. That's a lot cheaper than $50,000, right?
Right.
So that is where this is the key. And so what we want to see, is let's look at the gap, like the difference. So in that first column, with a 20% down, where the appraisal comes in, it's $130,568. With a $25,000 gap, it's only going to cost them, what is that? About $2,000 more out of pocket. People can afford that. That's
Right.
not too bad.
Right.
And then if it's $50,000 difference, look at that. It's about $5,000 difference. So the monthly payment stays the same as if you were putting 20% down. The difference is paying the one-time premium of mortgage insurance. So it's not included as part of the monthly. As you can see, the payments are the same for the first three. Now, obviously in that fourth column, you're putting a lot more money down, and your payment goes down by about $114 a month. Now, not everyone has an extra $18,000 sitting around, and they want to have at least some kind of strategy so where they can feel comfortable going in, that even if an appraised value comes in $50,000 shy, their payment stays the same, and their cash to close goes up maybe $5,000. So we've had some great success with this, and not all the lenders understand it, and they're not comfortable with it because they don't know it. So yeah, questions.
Wow. I mean, that's so interesting. I love this opportunity for people. So to explain appraisals, the reason why we're having an issue with appraisals now is appraisals are looking at yesterday's numbers. We're buying at today and tomorrow's numbers. So
that's right.
For everybody to understand, that's why we're having this appraisal shortfall. And it's not that the property's not worth what you're paying for today. It's just that the appraiser has to show actual hard data, and they're only looking at yesterday while our market just continues to go up and up and up. So there has been fear from the buyers in the market of feeling like, well, we're getting priced out, we don't have enough cash down. So this is an opportunity for somebody to be like, you know what, we can compete. So how would we structure this, Tim? Like as somebody's coming to you and getting pre-approved for a loan, and we know that, we can do our best guesstimate of what a property may appraise at. None of us ever truly know until that appraisal comes in, but we do our best to say, okay, on average, we're looking at about 3% above, what it's listed for is usually where they're coming in at. So would it be in the buyer's best interest to come to you and say, all right, we need to plan for this. So you need to have roughly an additional $2,000 to $5,000 cash down, something like that?
Yeah, right. So yeah, really great way to set that up just like that. So here's the thing that I can't stress enough is whenever I have someone call me that's on the weekend and I've never met them, and it's an introduction, and they found the house of their dreams, it's too late. It's not going to work. It never works. So all the more important is to really be in a position where you are, what we call it is the pre-approval. You and I talk about that all the time, the importance of that, because face it, this is your largest investment that most people make. And why would you want to risk losing an opportunity? Like doing your homework and setting yourself up with a lender, with a strategy, with a plan, and understanding these numbers.
Right.
And so when you and I work together, we're doing this with our clients already. So not all lenders are created equal, nor are agents. So you and I have the have great track record of working closely together, because obviously you and I have to know, have to anticipate for our clients and where the market is and what their budget is. So it's very much to where we have to take that all into consideration. And when you compress that into like a few hours, guess what? It's a mess. It doesn't work. So this does take time, getting all your data together, getting all your income and assets, and allowing me the time and you and I to work on a property. Because when properties come up, we have anywhere from usually 3 to 5 days, maybe a week, to be able to turn in that offer. And that's enough time for us to do a plan like this. And these plans are custom made, and it's always based on what the client's budget is, what they're comfortable with, and sometimes a little bit uncomfortable if they want it bad enough. But it's also, again, you and I understanding the market the way you do, and then you and I coming up with a strategy that makes sense for them. And ultimately, it's their decision. What we do is we just prepare them to be ready for an offer. So prior to an offer, we're walking through these numbers like, hey, how do you feel about these monthly payments? How do you feel about all this cash to close? So yeah,
well, I think this is fantastic, and I'm sure that we're going to get a ton of questions after this, because to me, putting down $2,000 versus $20,000, I'll take $2,000 all day long.
Sure.
So, but I don't think people know about this. And so I'm very excited to share this. And I'm so grateful that you actually take the time to go through these different strategies with folks, and that we do understand the market here. And we do spend a ton of time studying and looking at the numbers and values and strategizing how people can truly still compete, without having the huge amount of cash to put down. Save your cash for the renovations, right?
Exactly, right. So one of the questions, when you start to look at these numbers, like, wait a minute, how is this possible? How are we able to structure this, right? So here's what it is. And I mentioned it earlier, but here it is again. So when we go into the mortgage insurance, and that's what this is, UFMIP, that stands for upfront mortgage insurance premium. So what that is part of your closing costs. So instead of carrying a monthly mortgage insurance premium as part of your monthly payment, you're actually paying a one-time premium as part of your closing costs in the overall cash. Okay, so you are putting a little bit less down, right? Or you're putting a little bit less down, but you're paying that premium, and that's where the lender is assured, because you're putting less than 20% down, but they will still lend the money because you've paid that premium as the buyer out of pocket to protect the lender. So instead of coming up with that hard cash, we're willing to increase the loan amount, thereby keeping your down payment lower, right? To not have to make up that cash difference.
Okay, so let me jump a quick question, clarifying question. So instead of us coming in with 20% down, we're now only coming in with 15% down, say. And the reason we're able to do that and not increase our payments is because we're making that upfront additional mortgage payment. Mortgage insurance payment.
You're actually, let me correct myself. The down payment remains the same, as you can see, across the board, except for column 4. The difference is we're willing to lend because there is a gap. That gap is covered by that mortgage insurance premium.
Got it. So it's only covering the gap. Okay.
Correct. That's right.
Okay. That's why it's a smaller amount of money, and it doesn't increase your payments, your monthly payments.
Not only the payments remain the same, it's the difference is made up with the mortgage insurance. It levels off everything. Some lenders that I've heard on the mainland are calling, oh yeah, this is appraisal gap insurance. Well, it's not really appraisal gap insurance. It's mortgage insurance. It's always been here. So this is a perfect example where you would apply that upfront mortgage insurance premium. So yeah, hopefully that helps explain things.
Okay. Yeah. So Tim, when I come in to see you and we connect and I'm the buyer and I want to make sure that, I can get the property that I want to go for. We don't know what it's going to appraise at. You take a look at my finances. You see how much cash I have. We talk about my monthly comfort budget for my mortgage payment. And then we together come up with a value that I'm approved for. So when we look at this appraisal gap, we know that I have, let's say, $50,000 in cash, but maybe I'm not going to use, I don't want to use all that 50,000. I only want to put 20% down. And so when we're talking these numbers, I'm trying to see how the easiest way to word this is, you're able to know and guide me through my options, whether when my appraisal is short, whether I want to put, an additional 25,000 down, which I may or may not have because you've looked at my cash, or whether I want to just put the $2,000 down that I can pay in the upfront mortgage insurance premium to cover that gap, right? Like you're able to strategize that with me and know my cash and provide options and still keep me in my budget.
Well, so look at those numbers. So when we look at these numbers, let's see here. What's really changed here? I mean, there's not a big difference. So like keeping people qualified, there's not a big shift. It's $5,000. It's like, and that's something we converse. That's something we cover in the consult. When we're talking with clients, when I'm interviewing a client, it's like, tell me what you're comfortable with. And then we work within those parameters. If it starts to get above and beyond, then there's, the possibility of gift funds, etc. However, but for this particular scenario, which is much like many of the buyers that I work with, there's not a whole big change in the monthly payment. Right. None in this case. No. It's really about the cash to close and the ability to just pay that premium and make up that difference. So it's all right there. It's so easy to overthink this, me included. So I've done a few of these, so I'm starting to understand it better. So I probably could do a better job at explaining, but every scenario is going to be different. Yep. And in actuality, this is a proposal right here. So here's what happens is, let's say once we go into escrow, what I do is I start to manipulate this and start to go to actual real numbers and then once the appraisal comes in, we revamp it again. And then we're starting to get very close to what it's actually going to be. Correct. So, I mean, and here's the good news. I've done plenty of presentations like this with clients on these consults. You're getting all ready. And guess what? The great news, the appraisal comes in right at the sales price. Yeah, you don't need it. And that's always the best, right? So we overplayed it, but it's good because clients are prepared. Everyone goes in with wide open mind and they see what their budget is and see that we've laid it all out for them. So it's really a win-win situation. It's a matter of having the buyer understand it. And it does take a couple of times to explain it and walk it through to where they get it. And it's like, when that happens, you just see them light up. They're like, oh, yeah, okay. Yeah, I was overthinking it. So yeah.
Well, and honestly, it's about knowing your options and knowing, there is another option out there for you as opposed to coming up with an extra $25,000. And so, while there's a lot of technical places of doing this, for the consumer to understand that there are options, you don't have to stress if you don't want to put that additional $25,000 down. You, Tim, have options for them to be able to still go forward on the home that they want.
That's right. Yeah.
Yeah. Good. Well, greatly appreciate this information. I know we're going to get a ton of questions about it. And so would love to just make sure you're available if that comes up. And, we can certainly offer this up to folks and, just another resource to not be shy about going after the property you want. And one more question that just came to mind.
Sure.
Does this work on all loan types? So VA, conventional, FHA?
Yes, yeah. It can. FHA, you probably won't wind up doing that. There's not many FHA loans being done, but in the rare case there might be an opportunity for. But for VA, I'm doing a purchase right now with I'm at $1.5 million using the same strategy, because we know that there's going to be a shortage on the appraisal. But clients they're starting out with 10% down, and I've showed them increments of 8%, 7%, and 5%, and it all works. So yeah, everyone's scenario is going to be a little bit different, but happy to provide that.
Awesome. Okay. Well, Tim, I thank you for your time. It's always a pleasure. And thank you for teaching us about this cool appraisal gap, as we talk about it in the industry.
Absolutely. My pleasure. Great to see you, Jodi.
Okay, you too. Thanks, Tim.